All right. Well, thank you for joining us virtually for this Scale School event, Perspectives on Investing at Scale, hosted by Venture Lab and Lifelong Learning. I am Irina Yen, Director at Venture Lab at the University of Pennsylvania, powered by the Wharton School, and it's great to have you with us. Today's program will be led by Professor David Hsu, the Richard A. Sapp Professor of Management at the Wharton School, and also the Associate Faculty Director at Penn's Weiss Tech House. Professor Hsu will be joined by two brilliant panelists, Eurie Kim, the General Partner at Forerunner Ventures, and Ravi Viswanathan, Founder and Managing Partner of NewView Capital. Professor Hsu and our panelists will discuss the criteria and thinking behind the decision to invest in scale and how their perspectives may or may not evolve in the near or distant future, given the current financial and capital environment. So how today's Scale School program will work, Professor Hsu will lead the program with a brief presentation, followed by the discussion with our guest panelists. Q&A will take place after this, and if you have a question, you may submit them throughout the program via the Zoom chat, and these questions will be fielded during the Q&A. Our program will conclude after the Q&A. So let's get things started, shall we? Please welcome Professor David Hsu.
Thanks, Irina, and welcome everyone. I'm really excited to be with you today, and thank you so much for taking a little bit of time out of your day to join us for this edition of the Scale School, Perspectives on Investing in Scale. I'm going to start sharing my screen, in which I've got a presentation, and hopefully you can see this. As Irina mentioned, we're going to do three things over the next hour. I'm going to take around 10 to 12 minutes to make some introductory remarks and setting the table, giving you some facts, some figures, some perspectives. And then we're really going to just jump in directly with our two experts. Eurie and Ravi, you've got their bios associated with this event, really deep experience. And we're going to reserve the final 10 to 15 minutes for your Q&A. And so anytime a question arises that you think about, go ahead and put it in the chat, and we're going to try to work through as many of your questions and comments as possible. Now, I don't think it's going to take much motivation in this crowd to really motivate the importance of venture scaling. What may be a little bit less obvious is the knock-on events to successful scaling. What I'm showing you here in this diagram is all the angel investors that were minted through the Google IPO, who then subsequently became angel investors to the next generation of valuable Silicon Valley startups. So companies like Twitter, Facebook, et cetera, were seeded by these angel investors. And the consequence of this is that you get this reinforcement, not only of financial capital, but of know-how in building and scaling enterprises at the regional level. And so this is something that we should really care about. And whole societies have discussed the extent to which they're able to successfully scale. So I'm showing you Waze and Mobileye. These are two Israeli startups, Waze acquired by Google, Mobileye acquired by Intel. And there was a lot of discussion inside the country of Israel that they're indeed startup nation, but not necessarily scale up nation. And so they may be missing out on some of those recycled wealth or know-how mentoring type of relationships. Now, we have to take a step back before we get into the substance of today, which is directly going to be on the financing of scale. And so to kind of dial things back to when we had bespoke manufacturing. It's very difficult to scale when you are in this type of world in which you're just making one thing, making it in a very tailored manner. If you want to scale, well, guess what? It's very labor intensive. You get everyone in the factory with their collection of tools and inputs, and that's how you scale. It's not so great. We fast forward to the machine or digital age, and things are very, very different. The economics fundamentally change. To get to the first unit of the Tesla car, you need a huge amount of investment in both the software and the hardware. And then the next marginal Tesla that rolls off the assembly line, the marginal cost is very, very low. And it doesn't just apply to car manufacturing. Even in my own profession of education, we have a very successful class among the entrepreneurial faculty at Wharton. Some of you may know about it in Coursera and lifelong learning, in which we spend a lot of time, some 8 or 9 faculty, recording content, but then we put it out there. And now, as I think as of last week, over 100,000 learners in this particular module. The common denominator here is that you have this, this period of time in which you have a lot of slow progress for a lot of effort, but then some tipping points in which you have a nonlinear output to the inputs. And that's also what we mean by scale in the organizational sense. But when we talk about the organizational sense, we have to think about the many different facets of scaling. I've listed many here. And the way I like to think about this is much like economists have this theory called the O-ring theory of economic development. And the idea, it's taken unfortunately from the Challenger 1986 disaster. You can build everything correctly, but if you miss out on one thing, it turned out to be the O-ring in the case of the Challenger, you literally cannot have the rocket ship take off. And I think the same thing is largely true in the scaling domain as well. Not only do you have to master the human resource element of the organization, but the organization itself with respect to strategic decisions, organizational scope, customers that you're touching, the geographic locus or the operations, as well as the financial. All those things have to go correctly in order to really successfully scale. Today, we talk very much about the financial aspects of that. And I wanted to give you a small lay of the land in terms of what's happening in the domain of the venture capital industry. Very paradoxically, even though we are just emerging out of the COVID epidemic, it's a little bit of a tale of two cities or two economies. You have Main Street really hurting, but in the domains of venture capital, it's never been better, right? And so you've got 2020 almost setting or perhaps setting records in terms of the volume of activity in both dollar amount and number of deals. And if we zero in on late stage deals, again, that momentum is pretty stark, and going even into the first quarter of 2021, really eye-popping number of deals. There's a lot of discussion whether things are getting a little bit overheated. One thing that has perhaps been feeding into this, and maybe something that we'll talk about with the panelists, is this rapid acceleration of special purpose acquisition deals, SPACs, in the public markets. And that is an unmistakable trend that's been going on. And just to give you a little bit more lay of the land here, I think this is my final slide before we turn it over to the panelists. There was a survey taken mid last year of venture capitalists, 1,000 of them. And they definitely felt like they were going to be impacted and that would affect their pace of development. But it turns out that they were pretty optimistic on the whole. That yes, they thought that their funds, internal rates of return might decline, but they still felt like as a category of investment, that the category of venture capital would outperform the public markets. That obviously remains to be seen over the long run. But just to conclude this segment here, actually one more slide. This is about the startup labor market amidst COVID. And this is using angel list data. And what it's essentially showing is that from the standpoint of the ventures and the workers themselves, there's a little bit of a flight to safety in that they prefer to join perhaps scale-up companies, late-stage firms, relative to early-stage firms right after the onset of the shutdowns around COVID. Again, it remains to be seen whether that labor market dynamic is perpetuated as we get further distance from that shutdown. But just to recap my tentative conclusions here, successful scaling, that's an important concept to many different stakeholders, entrepreneurs, investors, societies. In order to successfully scale, it's not just you've mastered this one thing the customer groups. No, you have to worry about the organizations, you have to worry about the markets, you have to worry about competitors. And importantly, today, we're going to focus on managing the financial side of the house, particularly with respect to external capital. At least right now, there seems to be abundant financial capital for scaling. That remains to be seen how long this capital market environment lasts. But among the things that I'm going to be probing with Ravi and Eurie are these conclusions correct? And let's try to take it down, not from the 20,000 foot level down to the individual enterprise level, and see where we can come out in terms of knowledge for action. And again, I encourage you at any time to contribute your questions, because I'm going to be turning my attention to the questions in the last approximately 10 to 15 minutes of the session. So I'm going to stop screen sharing, and I'm going to invite Eurie and Ravi to join the spotlight here with me. And I'm going to start opening things up. So the first question that I'd like to just start with, Ravi and Eurie, what are the high level, what are the most important signs that a venture is ready to successfully scale? Or restated, a question submitted in advance by Darera Mukta, Wharton grad from 2013, what does an investor look for in a business to determine if it's scalable? Eurie, why don't you give us your opening thoughts on this question?
Yeah, as we were talking about this one to kick off, I was laughing at the word ready, just because it's kind of, you're never necessarily ready, that getting that timing so perfect is really a mirage. But when we're looking at our companies, we invest early, and that's one thing between Ravi and I at Forerunner, we're doing mainly early stage. So seed, Series A, occasionally Series B, but we have the benefit of being able to scale alongside our best companies. So having gotten to see many of them hit CD, get funding from Ravi and his team, or go IPO. So the full view there. And I would say that what ends up happening is there's a moment at which in the early days, you're just trying to figure out if this one idea, this one product that you have actually works, and that someone will pay you for it, and that there seems to be some benefit that customer is getting, such that hopefully they start to enjoy it, stay and use it, continue to pay for it, and then hopefully tell their friends. Beautiful, right? Then when you start to see that happening, you build your team, you start to invest in that momentum, but it can't just be the one thing. You have to start to build out the rest of the experience. People want more, your customers want more features, or there needs to be more of a broader sort of market approach. And so the pressure kind of lays in on what else is it? It can't just be that first feature, or that first product. And so I think when you ask, like, when is the venture ready to scale? It really is that you have a complete experience, albeit not like everything, but there is a complete experience that seems to be working, that you can repetitively make for your customer and repetitively sell. And that by and large, they're pretty happy after they buy that service or product or experience. And the readiness of scale that's kind of the market saying, hey, we like what you have. The readiness to scale is what you kind of touched on in your slides. Do you have the team to scale? Is your manufacturing prepared to scale? Do you have the capital to scale? And if you scale, what does the next level even look like? Like, what does scaling mean? Does it go from 20 million in sales to 500 million in sales? Or are there milestones along the way that you can kind of get to the next milestone, which is in that inflection point that you showed in the curve, that hyperscale or hypergrowth? And it's just a really challenging, painful, confusing time, because even when it goes really well, you're sort of drinking from a fire hose. And if it doesn't go well, you're drinking from a fire hose. And so I think that, everyone should just be honest, which is that it's really hard to scale. And I have, we can share examples, but I'd love to just let Ravi, chime in too here before we get too far into my stories.
Okay, thank you, Eurie. Ravi.
Yeah, it's great to be here, David. It's also great to be here with my good friend, Eurie. As she'd mentioned, what we do is more mid-later stage, and also sector-wise a little different. Although we do look at consumer, it's more enterprise and fintech. And I would say a lot of what Eurie said resonated with me. It really is around product market fit. And What we look at is, we call it the physics of a business. And really that is the metrics, but it's not the growth metrics. People generally think it's the growth metrics. And that we'll talk about certainly in this discussion on equating that growth with product market fit because of the amount of capital. We look at what we call efficiency metrics, which is every dollar you invest, how efficient are you? And that could be, at least in the enterprise role where I play, net and gross retention. So are customers holding on, and do they want more? We look at LTV to CAC. We look at magic number. We look at a lot of these metrics where once you really know it's working and it's hitting, then you start over investing in the go-to-market engine. And both of us have lots of examples. One, probably the most pertinent for me, is just MuleSoft, a company I backed, the enterprise software space. And they saw these metrics and they were all best in class, and actually pushed off the IPO so that they can overinvest, raise a big private round, and significantly overinvest in the go-to-market engine. Now, we'll also talk about the team, but it's not just the physics and the metrics, the efficiency metrics, but also the readiness and the ability of the team to scale as well, to Eurie's point.
Yeah.
Okay. That's a great, between the two of you, you've really emphasized kind of the predictability, the product market fit, the metrics, particularly as you get into that phase of up growth. The second question I want to ask you is, again, by way of kickoff, in your experience as investors in this domain, what are some of the kind of usual pitfalls that you have seen ventures who have attempted to scale? What are some of the most common pitfalls that you've seen? Again, let me start with Eurie.
Sure. When we first started our firm back in 2012, it was all about on-demand everything. And you name it, like it could be delivered to you right away. And when we saw all these companies, we thought, okay, this is a huge trend. Like we need to think about how to play it. And every company we would look at, it just was so obvious that the unit economics were upside down, gross margin negative, and somewhat into perpetuity. We had no idea when it was going to turn around. And so we chose not to invest in the category, because for us, we felt like even if this became a wild success and you assume that volume and scale can forgive all ills on the margin side, with my partner and I having some experience on either the public market side or even the private equity side, you just want to be building a good business, a good sustainable business. And so one of the pitfalls is, that people get really excited about customers really loving what they're doing and what they're giving them, but it's not even close to being sustainable on a margin side. And so if you did make it sustainable, for example, one company that I seeded back in the day is called The Farmer's Dog. They offer fresh human grade food on subscription. It's pet food, it's dog food. And at the time, the price point was some odd like $280 a month. I'm a dog enthusiast, and even I wouldn't pay that. But they had to do that to make the margins work. And then the question was, there were many competitors that came in with half the price, but more than half less margin. And we made the decision as a board, a small board, albeit me and the co-founder, the founders, to say that we were just going to keep the high price with the understanding that over time, as we could lower it, we would. But at least we would have customers that understood what we were doing, and it would buy us time to figure out our manufacturing. We're now over 300 million in run rate at that moment that Ravi's talking about, which is you can totally jam on growth because your system is working, and all the other competitors have died out because their negative gross margins or poor gross margins led to too much burn and too much drain of capital. And so those are decisions that are hard to make because you feel all this pressure to grow really fast. And that if you could just do it 10% cheaper or, this much, more CAC or, whatever it is, that you could show more growth. But I think that smart investors, like Ravi and hopefully like the ones that we all know, will look at these metrics and say, hey, this is not sustainable. And as a result, you as the founder or entrepreneur that's leading this business is going to do stuff that in your heart doesn't feel like the right answer, but you're doing it for some other reason. And then it ends up kind of biting you in the butt at the end. So I think just, staying true to what business are you building? What are the inflection points where once you hit a certain level, that would actually mean that certain metrics would be unlocked. And knowing how to get to those kind of next tiers is what we look for. And, ultimately where we'd want to lean in on bigger sort of tranches of capital.
Okay, I have a follow-on to that, but I'm going to allow Ravi to weigh in first because there could be some points of intersection. So Ravi, what are some common pitfalls that you see all the time in your business?
Yeah, a couple. And the first one is very similar to what Eurie was saying, and that is just equating pure growth with evidence of product market fit. And that now it's even more relevant, just given your slides that you presented, David, that shows this hockey stick in venture capital getting raised and deployed. Not the best hockey stick you want to see, but so there's so much capital. So people just look at the pure growth and they don't look below the line in terms of how much you're burning. And this gets to the negative unit economics that Eurie had mentioned a couple of times. And so that is incredibly deadly and dangerous. The other, I would say, is not having a scale-ready management team. So a team that still operates subscale. What subscale is, and we've all had companies like this, it's more of a hero sale. It's a founder-led sale. It's a couple of people just grabbing some deals before the end of the quarter to make their number. It's not having a CRO, systems, processes, a scale-ready team to really do that. And the other thing I tell our teams, decades ago during the telecom boom, you would have this phrase, overbuild your network. We tell our teams to overbuild your team. Because if you think about a hyper-growth startup, say they're growing 100% a year, in 2-3 years, it's going to be 4 to 6, 4 to 8 times what it is now. If you think about talent taking 6 to 12 months to get really good senior talent, before you know it, you'll have grown past your team sometimes. And so if you really think, in 18 months, I may be ready for a COO, we tell them get them now. Because it'll take you a while, take you a while to start integrating people. But I would say that's the second biggest one that we work a lot with at our companies, making sure that the teams are ready to scale along with the businesses.
Okay, those are both excellent points. I have a follow-on to your second point, but I want to return to the first point that you both made, which is you're essentially saying something that I think differs from perhaps the conventional wisdom, which is many out there might say, look, you want to expose your customers, get them to try it because, they may not know. But essentially you're saying is almost immediately you'll want to avoid this negative unit economic situation. And so my question to you is, are there any caveats to that, whether it's by industry context or anything else, or do you think that really is the path forward in terms of you're going to validate the core value proposition, and it's only going to get better as your scale gets bigger in terms of lowering your costs, et cetera. But we can't really see if you have a real business if you're just subsidizing everything to death. So Eurie, come back on this.
Yeah, so I'm an investor in a company called Eclipse, and they create plant-based dairy, a unique sort of IP that they've developed, which allows them to have a milk product that is indistinguishable from the taste of real milk. So with that, you can make ice cream, we can make ice cream, which is our go-to-market product. We can make cheese, we can make other dairy products with this plant-based non-dairy dairy. It's exactly this question where we are so subscale from a production standpoint. We're literally producing in Oakland out of a kitchen, which is very similar to the farmer's dog. We were cooking dog food out of a kitchen, with a big vat. Doesn't work. But in this regard, there is a price point that people will pay for ice cream. So no one's going to pay $48 for ice cream, even if you love the ice cream. So that has created this situation where even though our margin profile is not anywhere close to where we would want it to be, we're somewhat bound. We're still premium priced, which we decided to go with, but we're somewhat bound on where we could go. Otherwise, we can't even get started. So I think in this situation, as a board member, the founder and I talked about it, and we decided we're going to go with this. We're going to go with this price point that's slightly premium, but not sort of obscenely premium, because we want to just be an ice cream that is the same as every other ice cream, maybe a boutique ice cream, but we're not trying to be something so wildly different. In the farmer's dog example, we would never want to be compared to kibble. It's just vastly different things. What you're comparing it to is you going to the market, buying some turkey, buying some rice and vegetables, cooking it and, making it for 3 hours. So then it's a lot cheaper than that. So we decided that those two scenarios were different in the margin kind of compression or pressure that we were feeling to be able to get to the product market fit. Does that kind of
Yeah,
nuance
that's
help?
excellent. Thank you. Thank you. Ravi, do you have anything on that point, or should I ask you the HR org type question?
Very quickly, I would say I actually think there are caveats to your point, David. And the two caveats, building on what Eurie said, are freemium business models, at least in my world, and open source. And that you're right. So there's not situations where every single deal, the first customer has to be unit economics positive. In some businesses, you want to build a community. Open source, we've done a lot of open source. That's a beautiful example. Freemium also, where you want to build a community, but you still want to be able to test product market fit. But what the difference is, you build a community, but you have an eye towards making it an efficient business model. You have an eye towards at some point getting operating leverage and scale versus building that community and continuing to just build that community for the sake of building that community, where you're just basically pouring money down a black hole. It's a nuance, but for sure there are situations, especially if you look now where enterprise, there's this whole consumerization of the enterprise, where it's becoming more developer-led, bottoms up versus top down. That community base is really important. So I think it's a good point you raise.
Okay. I want to pivot a little bit to the second point you originally made, which is on being forward-looking on the talent that you bring in. And there's a lot of appeal to that, because you don't want to be catching up as you scale on the human resource and talent side. Yet it's a little bit of a dilemma, because what if growth doesn't go as quickly as you had planned? And this, I think, relates to the question I'd like to pose to both of you now, which is, how do you think, in the context of the organizational culture that you hope to achieve as your organization scales, how do you prioritize or think about promoting from the inside versus from the outside, some of these key hires? And this is a question that we received from Frankie Lamb, Wharton grad, class of actually 22. He is asking, how do you think about internal versus external hires as you think about the talent acquisition in the scaling path? Let me maybe reverse the order and ask Ravi to go first, and then we'll get Eurie.
Yeah, it's a great question. As anything with these situations, it's always context-based and it's always a balance. I would say that what we have done a lot is you have really strong founders. Some can take it the distance. Like, I was an early investor in Plaid, and Zach Perret, he has taken it the distance and continues to do so. There are others where they need help. And actually, I'd say Facebook 15 years ago, it's a quote unquote pioneer when they brought Mark Zuckerberg, who was a product-led founder, brought in Sheryl Sandberg, a very strong number two. You've had other situations, Dennis Woodside at Dropbox, other companies, and a bunch of my companies have done that. And so you bring in someone that's institutional, that can scale, that has been there, done that, still has kind of the heart of an entrepreneur in terms of their spirit. And so you do bring in that external piece, but you're also making sure that you are able to develop from within. So it's really a balance. Where it gets to be a little tricky is when you're in that hyper scale, you just need someone, right? And sometimes in some situations, like go to market where it's so complex, I've seen a lot of folks bring in external CROs, for example, but in other functions, such as the finance function, you have some really hungry young folks that are able to grow with the company. So it is a balance. We've seen it both ways. I think that I've not seen situations where it's only one versus the other. If you just bring in external, you won't be able to keep people. If you just do it internal, unless you're the best hiring person in the world, which is rare, it's also tough to do that.
Okay, thank you. Eurie, what are your thoughts on this?
Yeah, what I would add is, where I am right now, either kind of Series B, Series C, is that just in the early days of scaling and starting to figure stuff out, is that the org design is constantly evolving, like the org structure that you have. And what you need 2 years from now is great, but you don't have that right now. And to Ravi's point, it takes a long time to find the right people. So you somewhat have to be able to keep your eye on the forward motion and the forward vision, but rather know that there's going to be a few skips and jumps along the way to figure it out. You can't hire everybody ahead of their own position, because then you end up like not necessarily having all the people to do the work right today, like hit the ground running. And you can't do the opposite, because then you don't have enough vision and experience around the table to kind of start to pull your management team into a more senior level. So I feel like that is a real tension area and a growth area for founders and teams that I get to work with. And, some of it is just really thinking about the roles that you need for the company, irrespective of who you have in the company now. And then looking at who you have now and seeing if they map to the roles that you need or the roles that you're going to need. And just eyeballing that, because one thing I have seen as a pitfall is because you have this one person who can do 3 things and like she's really, really good, you don't hire for those things because there's something else on fire over here where you have nobody. So then you end up focusing here and hiring this person and go on, so on and so forth, until you realize that this is actually the thing that's been holding you back, because this one person may have been amazing general athlete, but then is like master of none. That's painful because, you have to leave someone, we're having this in a couple of different companies that I'm working with. Your hardcore early believers, like blood, sweat, and tears for 2, 3, 4 years. And like, now you don't have a place for them. It's so difficult. But I will say in scale, if you can't make those decisions at the time you need to make them, you will be holding yourself back and your team back. And so you just have to be honest with like, what is this person's capability set now? And where do you actually think it's going to get to? And then how does that map to what you actually need in the company?
Okay, thank you. And I'm just going to take a 2-second pause to encourage everyone at home to be chatting in your questions. I'm unable to read them, but we do have a moderator who's going to come in and feed me the questions. So let me turn to let me turn a little bit to some of what's happening directly in the financial capital markets. In the venture capital industry, we saw that it looks to be going gangbusters. And so my question to each of you is, not only do you expect that environment to continue, but what do you see as anything positive or negative as a result of this environment for you as an investor, for the portfolio companies that you're involved with, the boards that you're on? Is this a good thing? Is this a bad thing? What are the long-term consequences of this kind of, anomaly? It seems quite amazing that the capital markets in this domain are going gangbusters. But if you would kind of think about any of those questions that I posed, what comes to mind? So Ravi, let me start with you. Capital markets, what do we expect going forward? What are the consequences?
Well, as I mentioned to you, I'm exceptional at whiffing on this every time I try to predict. So you may want to take the anti-approach to what I'm saying. I think that there's 2 things. One is the free flow of capital and the valuation environment. I think the free flow of capital, you saw that capital getting raised. Our mandate as VCs, we have 3, 4, 5 years to commit that capital, right? So I think you're going to see a significant amount of capital continue to be coming into this asset class. And COVID only accelerated that when you found that actually venture capital in terms of innovation, technology, digitization is really powerful. The valuation environment, I think that when you see companies getting done at 50 to 100x ARR, I think that is very troubling. You're just pricing things to perfection. Used to be my old firm NEA would talk about, all right, how much forward are you paying it? Are you paying it 6 months forward, 9 months forward? These are 2 or 3 years forward. Mm-hmm. So I think that is troubling. So the positives though is the liquidity. Venture capital is an asset class. There's a couple trillion of private market valuation. There's a significant amount of liquidity that's happening in the last few years and in the forward calendar. That's great for the limited partners. Without that liquidity, we don't exist as an industry. It's a positive. I think that the negatives are this valuation environment, which I think will change. The other negative I would say, and I see it most acute now, and in 21 years of venture, it's never been like this, is the speed at which deal making happens. So, you're making a decision to enter into a partnership with a company for a decade, 5 to 10 years, right? Even as a growth stage investor. And sometimes the process is akin to speed dating for a long-term marriage. You're days to weeks. And that is very troubling because early in my career, I would get seduced by product, technology, or market and not realize I'm going to be spending time, probably a decade with this founding team and this board. And so that's what troubles me. And the hope is that people, especially the entrepreneurs, continue to do diligence on us as they should, and not make it more of a ball where they just get the highest price term sheet. So those are the things I would say.
Thank you. Eurie.
There's so much good stuff in there. I was reading one chat question who was kind of commenting that we seem operator founder friendly. And so what happens in the opposite scenario when people are investors can be a little bit more tough. But it's exactly this, where you have this frenzy going on. So you as an entrepreneur feel kind of bad if you're not getting some hot term sheet with a outsized valuation, a big round, all this action's happening. And so you are just as seduced to take that deal, but then you're stuck with what that expectation of underwriting is for your business. And so you can't do what we just spent 20 minutes talking about, which is making sure that you're ready to scale, making sure that instead of leaning on growth, you're building the right team and making sure your manufacturing, your production's all working, or your technology is stable in the case of SaaS companies. And so I think that, in a free flowing market, what ends up happening is that you can't not raise money, because if your competitor gets, a $100 million raise from Andreessen, you are up a creek, because they're just going to make it so noisy in the market that even if you have a better product, over time, it's just difficult if you're not well capitalized. So with our companies, we tell them, hey, if you feel like you're in a moment where you can have a great partner that you believe you want around the table for the next 8 to 10 years, and it's a price that you feel is commiserate to what you think you can live up to. It's not even what you like, but you just know that you have to clear that for the next round. That what does that imply for the business that they think you're building, and how much risk is around that alignment of expectations, that you just go in eyes wide open, because no one's throwing money at you and expecting nothing in return. And, you can always, you don't want to think about it, but founders can be fired. CEOs can be fired. So just the lure of all of this money is just more money, more problems. Build the business you need to build, push yourself, because this is a scale moment for your business. But if there seems like somebody's throwing money at you and you don't even know what you would do with it, don't take it, because then you will do something that you don't need to be doing. And that is the lack of focus. Then it starts to take you off course, right? Your discipline starts to go out the window. You start hiring and doing campaigns that you don't normally think about. You're not as scrappy and as focused on, the product market fit. Why is this winning? Well, I can't tell. We're still growing 20% month over month. So no one bothered to figure out that retention was plummeting, so I think that, it's the onus is on the founder, unfortunately, more pressure on you guys to be able to really think about who you're partnering with and why, and what amount of capital puts what kind of pressure on your business.
Okay, those are excellent points. It feels a little bit like, if for those of you in the market for housing, you got to just get in there, right? I don't know if you guys are feeling that way as venture investors.
That's a great comp. You're spending the most money you will in your whole life, and you get 10 minutes to go to a house and decide. And then you got to overpay by 50% or more.
Right.
And then you end up getting the keys and you're like, did it have a garage? I don't remember. Does anything work? No, it needs a new roof. You're like, oh, well, I guess we just have to, it's a horrible experience. But
no, but to your point, Eurie, I think it is important for the entrepreneurs to take a step back and say, it's tempting, but it's got to, there is a long-term process by which I'm going to be judged, and by whatever new financing team is going to be financing. So it better be productive. I want to ask a little bit about the domains of interest. You've already each self-revealed your primary areas of investment. It seems like many entrepreneurs are getting into the domain of platforms. That is kind of the ticket to the unicorns, the decacorns. What are your personal, and obviously that type of business only works if you're able to successfully scale. So have you, in your recent experience, and this is animated by a question that I've seen in the chat, what are your thoughts about selecting a platform-based business? Is it overdone? Are there still pockets of opportunity? Or should entrepreneurs steer clear of building those platform type of businesses? Ravi.
Yeah, in the enterprise software space, I would say starting with a platform is incredibly capital consumptive and generally pretty hard. We've seen companies evolve towards that. They have a core, think of it as concentric circles, right? They have a core and they, to our point, establish product market fit. Customers have to have it. They want more and more. From that core, adjacencies and other concentric circles start moving outward. And then before you know it, X number of years in, you actually have a platform and you start wrapping all that together. We found that to be more powerful, A, because you establish a beachhead and product market fit. B, you actually, by definition, focus the team, so you're not dispersed in terms of your aperture. And C, you actually build loyal customers, and it's almost like the customers have taken you there versus you plant a flag and say, I'm building a platform. Now, to be fair, there's lots of platform companies that have started from day one. Some have had spectacular fails, but the ones that work could be just are fundamental several $100 billion companies. So that's how we think about it.
Okay, that's super valuable. Eurie, any thoughts on this one?
Yeah, I mean, I think it's also the definition of platform and how people think about it. It's almost like in the consumer space, everyone would say, oh, do you invest in subscription companies? And we were like, what are you talking about? Like, what does the company sell? Subscription is merely a business model feature where if it's convenient enough to buy it on a repetitive basis, you might ask if your customers want to buy it on a repetitive basis. But I think that when you put that forward, then you're not thinking about, I'm a consumer investor, so you're not thinking about what is the actual customer problem and pain point that you're solving. Because if I were to just say, hey guys, I'm an entrepreneur, I'm going to build a platform for so-and-so, it's like, what does the platform do? And to Ravi's point, like platform means broad and, pretty all encompassing. So it's hard to do a lot at once. Where are you going to start? And then over time, if that's a productive, sticky solution to somebody's problem, like hopefully you can build more against it. Some people could never imagine that a direct-to-consumer product business or brand would be a platform. But the reality is, if you have a deep relationship with your customer and they buy multiple things from you, what else can you sell? Can you create a social network off of that? Can you create advice? Community. Ravi was talking about like the network effects that happen with open source or, even with SaaS. There are some things that are like, it starts to create so much stickiness that you can't unplug it very easily. Like Chime, we're early investors in Chime. It's a neobank. And now at so much scale, I mean, they're doing just an incredible amount of volume. But in the early days, it was just hard to start because who trusts a new bank? It's very difficult to get that going. But once you do trust it, who gets off their bank if they don't absolutely have to? And so the momentum just keeps on going and keeps on going. So I think that the reason why everyone's excited about platform-based businesses is because ultimately, if you have one that works, it is a beast. Like it's a massive idea with massive market cap potential. But getting from 0 to 1, it's really hard. So how, you just like, everybody wants to do that. So, it's just a matter of how you're going to do it. Do you have an idea that's going to get you the wedge to get the platform building started?
Okay, good. I want to pivot a little bit, and we've recognized that there's a lot of financial capital out there. At the same time, to Ravi's earlier point, the people with experience who have actually done the scale phase and to recruit, particularly on a forward-looking basis, these very talented people. I want to ask you, and I'm going to ask you to, if it's possible, to think about specific examples of this in your own investing or operational experience. Like, how do you, it's actually a little bit of a conundrum because for many of the people on the call, they're aiming to scale and they're forward looking, they want to get these people experience, but they may not be able to attract them. And so they have to tell a good story. They have to really excite these talented people to come in and join. Like, what have been some successful, if that's one of the keys that you can like deploy your financial capital to really kind of interest these people, are there kind of some tips that you can share with our audience in terms of how to, recognize these talented individuals who would really be able to execute well in the respective domains that you operate within? Maybe Ravi, if I could start with you.
Yeah, I'd say in my career, the two best CEOs I've noted in terms of hiring and recruiting people are Greg Schott at MuleSoft and Zach Pratt at Plaid. And, they were very successful companies, but in the early days, it was far less people, especially Plaid and FinTech, when they were really getting started, they didn't even know what this API infrastructure play was. So it was tough. They had to really sell the forward vision. And we'd always say, whatever decision the candidate came to is the right one, meaning the candidate couldn't grok that the risk that they'd be taking, then it wasn't right for them. They would stay at the bigger company or whatever. So it was just, but I think the biggest tip I could say is they just never let up. They would just, the number of doors that got slammed in them, number of people that said no, and they just never let up. And the other thing they did is, even in the face of that, when they were unproven, unknown companies, they would never lower their bar. So a lot of times, you're searching for a marketing person, for example, and you're in month 6, 7, 8. You're hurting because your demand gen engine isn't up to speed, and some folks are like, all right, we'll get the best available. These folks would have an absolute bar, not a relative bar, to a point where we would tell them it's taking you too long, but they just, thank God they didn't listen to us, and they stuck to their own instincts. And then what happens is the flywheel, then there's a tipping point, right? Now, what is interesting is these financing rounds are marketing events and branding events and also recruiting events. So once you get a couple of those, then it gets a little bit easier. And usually there is a Pied Piper effect. You get one great individual and he or she took a leap of faith, and this person is very, very well respected, and he or she becomes a champion and the Pied Piper to lead others into the company. But in the early innings, it is difficult for sure.
Thank you.
Yeah,
Eurie.
and I would just add that I have one team that I work with very closely, Aura, and they're at the Series C level, really building out management team, and they get a lot of heat from the board. We got a large board about, you got to hire faster, need more people, need more senior executives, this and that. But what we realized is that it's actually such a nuanced platform that we're building. It's the biometric ring, this ring that I'm wearing. It's a tracker. Oh, good job, Ravi.
I wish I had one.
I know. It's a community, it's health insights, it's, data and research. I mean, there's a lot going on. So there's nobody out there, to your point, David, that has this experience. If they do, they're still in that job getting the experience and haven't finished yet. And if they did finish, they have an N of 1 experience as such, because everything's happening right now. So I do think that the pressure to get the perfect resume can sometimes veer you off course from finding the right leader for what you're trying to hire for. And that's the hardest part with the founder, is really trying to meet enough people to understand, like, what is actually the capability set that you're looking for, that you believe is going to be most mapped to where your company is going and the leadership that you need. And I mean, we just brought on a COO at the Farmer's Dog, formerly the president at Melissa and Doug, but he was a very senior GM at Etsy before. And, we had so many questions around, do we need somebody who has deep supply chain background? Because our supply chain and manufacturing is so critical. Or do we need somebody who can actually run the team and processes and culture and HR and have a more like managerial, strategic view of the business? And we met all of both sides. And we came to the realization that we actually wanted someone with a more general manager, background, who didn't necessarily have to know pet, didn't necessarily have to know manufacturing of dog food or human food or food, did need to understand e-commerce, because that is something that is fundamental to the company. And most importantly, needed to be able to lead the company, the people in the company. And that person could hire the best supply chain executive underneath them. And it was a long journey. It took us probably 6-7 months, to Ravi's point. Like, it takes a long time to go through the discovery process. And, the person we thought we wanted didn't take the job. And then we realized, like, oh God, that would have actually been the worst person. Like, now we need to reframe our whole job description. And so this is an evolving process. And I would say what's frustrating is every time you hire somebody new, the next roles evolve. Because now you can, like, the personality types, the leadership style, like everything is in context to who else is around the table and what else you need. So, I think so many times, like, entrepreneurs will just like want the answer. You've seen it so many times, Ravi, like, please just tell me the answer. And it's just, I don't know. We can talk about it together. We can like weigh all these factors together, But at the same time, this is something new and unique, and whatever worked for MuleSoft is going to be 6 years old to the new startup that he's working on that's, starting from scratch. So what worked then is not going to work again. You want to learn from it, but you can't just like map it directly over. Everyone will be like, oh, I want to do what Warby did. Warby was a long time ago. Like shit's changed.
Yeah.
So, we all have to realize we're making it up as we go. Innovation. I think there was a question about how some investors are like, say they invest in innovation, but they really just want to like product that works and, invest in scale. That's true. There are people who are willing to take bets, and there are definitely people who aren't. My really good friend works at Coatue, and he always tells me, I'm always an idiot for not investing in the round you bring me into, but he invests 2 rounds later and pays 5x more. And he's like, I'm happy to pay 5x more every time because that's just his business, right? And that's okay.
Okay. There's a question in the chat about what do you think about scaling through acquisitions? And I want to tack on something, what do you think about SPACs? Is that something that you think is a good thing? It's an unhealthy thing? So treat one or the other or both of those two issues. Ravi.
Yeah, I'm a huge believer in scaling through acquisition. I would say I think venture, I've seen a transformation in the last 5 to 10 years where more and more companies used to be 20 years ago, 15 years ago, venture capital is all single threaded. You just build the whole idea of buying companies. But now I think because of the capital, because of how many companies are out there, more and more, it's probably 6 to 8 of my companies that have active internal M&A. And one of the companies I invested in a very long time ago, Global Logic, again, one of the best CEOs I've backed, Shashank Samant, he took the company from 30 million to 1.1 billion. A third of that was acquired.
Wow.
And so the only issue there is there's lots of pitfalls here because here's where your eyes are much bigger than your execution capabilities because you think, oh, here's the revenue scale, here's the multiple. The multiple is lower than the multiple we trade at in the private markets. So of course it'll be accretive, we should acquire it. And we've had lots of companies, even Global Logic, the first few iterations, faceplant, cultural integration, systems integration, go-to-market integration. So I actually think you're going to see more and more consolidation. And you're even seeing a lot more private to private deals coming to fruition. So I definitely think that's going to happen.
Great. Eurie.
Yeah, I think in the consumer world, at least my world, we see a lot less of that. Mainly because it's just so hard to put together the 2 different brands, 2 different teams. There's more tuck-in acquisitions. So I think Ravi's probably got more experience around that relative to, the enterprise side and things that are just a little bit more integratable because the customer set is the same. Like you have one customer, you can sell 2 different things to it. It doesn't mean that the 2 things have to like absorb together. But, the farmer's dog is considering this now and like, we're a little bit nervous. Like, do we really need to acquire for that? I mean, it's pretty expensive. We could just hire a team and do it our way. So I think it's a tension. I don't have enough experience there yet.
Okay, great. And for those of you at home, I apologize. I know I've left a lot of you guys hanging because there's a lot of activity in the chat. But to be respectful of the time, I'm going to ask each of our panelists to try to, this is after all scale school. And in school, you have to kind of recap and try to synthesize and leave the audience with, some takeaways. So if you had to try to think about the central message that you would like all of us to take home and to really remember some nuggets for us, what would you, and we just have a few minutes each for you guys to share some short thoughts, what would those key nuggets be? Okay, so let me start with Ravi. What would be the kind of synthesis of your thoughts on this topic?
Yeah, I would say the number one issue, it's an all-encompassing issue that our companies face as they hyperscale is really managing growth, but all aspects of growth. It's people, capital, systems, processes. And so all of our discussion, really wraps that in. The only thing I would say for folks out there, especially the CEOs and founders, the prize is massive. And just look at what happened in COVID. You started by saying there's Main Street and then the venture capital market. And for as long as I've been in venture, there's been an undying thirst for growth. Certainly a thirst for technology innovation, but a thirst for growth. And growth is achieved through scale. see it in the public markets, see it in the private markets, and the prizes are actually diverging. If you look at the multiples for lower growth businesses to higher growth. So it's incredibly hard, but the prizes are also exponentially getting bigger. So that's what I would leave folks with.
Yeah, it really resonates with this. I remember Andreessen Horowitz early on, time to build, and actually hugely prescient, right, on that. Eurie, what are your closing thoughts?
My parting words would be some perspective that we use in our business just for consumer investing, but I think it's actually resonant for this conversation, which is essentially growth or scale is the output of having served a customer something that they need. And instead of focusing on the output number, like how much month over month growth you have or how much money you're going to put on marketing, if you really understand what metric would need to be going well to be the leading indicator that what you are actually building matters and is working to your customer, that the growth will come as you start to lean into it. But I feel very much that people get confused about what feels like things are working without knowing the exact reason behind it. And so all of you have very different businesses. If you were like truth serum, you know, asked yourself, like, if this were really working and it could be a $30 billion business, what would I need to believe is working? And figure out those metrics and track those. And before you start plowing money into growth, you know, make sure that that's working for you.
Well, I was taking massive notes as the two of you were talking. So thank you. You know, before I turn it over to Irina, I want to personally thank you, Eurie and Ravi, for really being generous with your time.
Share your notes, David.
Your thoughts. Yes, I will. I'll type them up, post them. But let me turn it over back to Irina. She has some parting words for us. Irina?
Thanks, everybody. I've just put a slide up, which I'll talk to. Thank you so much, Professor Hsu, Eurie, and Ravi, for a very rich discussion, a lot of valuable insight for everybody and examples that you shared, and really important strategic considerations for our entrepreneurs. Thank you for providing also a framework for our entrepreneurs to kind of think through and plan for this stage of financing and growth. I'd also like to give a special thanks to the Venture Lab and Lifelong Learning teams. From Venture Lab, Director of Events, Allison Grant, Sarah Rodriguez, and Ali Crancer. You all have probably interacted with them via email, and also from Lifelong Learning, Director Amy Nichols and Associate Director Alyssa Swanson. Happy birthday, Alyssa. Please note, like in the chat link, in the chat, there'll be a survey link that'll be posted. If it's not there already, we welcome your input. And please save the date for some upcoming virtual lifelong learning programs, which you'll see here on the slide. Tuesday, May 4th, there's a program on the current and future of fintech. And also on June 3rd, a time to reflect and think again. So thank you all for joining us at today's Scale School program, Perspectives in Investing in Scale. And we look forward to seeing you next time. Thank you.